All right, let's dive into a professional case study on one of the most interesting and frankly challenging stocks on the market today, Eli Lilly. What we've got here is a company with absolutely phenomenal growth, but at the same time, a valuation that's just screaming for caution. It's the classic high growth paradox, and we're going to break down exactly how a professional thinks about a situation like this.
So here's how we're going to tackle this. We're going to use a disciplined six-part framework. First, we'll start with the final verdict, the bottom line. Then we'll define the core paradox at the heart of this stock. From there, we'll examine the growth engine and then flip to the valuation red flags. We'll uncover a really powerful contrarian signal and then wrap it all up with a precise investment playbook. Let's get started. You know, in professional analysis, we do things a little differently. We always start with the conclusion. It's a principle called bottom line upfront, and it's crucial because it frames every piece of data that follows. So let's not waste any time. Let's get straight to the verdict on Eli Lilly. So what is it? It's not a buy. It's not a sell. It's a highly strategic, cautious hold. But the most important part of that phrase is what comes next: selective accumulation on pullbacks. That single statement right there is our entire thesis. And for the rest of this analysis, we're going to deconstruct exactly why this is the most prudent approach. Okay, now we're getting to the real heart of it. This is the fundamental problem, the dilemma that every single investor has to wrestle with when they look at the stock. It's that classic tug of war, right? You've got incredible performance on one side and a sky-high price on the other.
So, on one side of the scale, you've got these incredible fundamentals. I mean, just staggering earnings growth, a totally dominant position in the obesity drug market. But on the other side, that valuation is stretched as tight as a drum. The high PE ratio, the neutral analyst ratings, they're all telling you the exact same thing. This stock has been priced for absolute perfection. There is zero room for error.
All right, so let's dig into the bull case. What is actually powering this unbelievable story? Well, it really all boils down to one thing: the earnings. And when I say explosive, I mean explosive. Just take a look at the trajectory on this chart. I mean, really look at it. This isn't your typical steady growth. This is a rocket launch. What you're seeing here is honestly one of the most impressive earnings expansions we've seen in the pharma world in a long, long time. And it's all thanks to the massive, blockbuster success of their obesity drugs. And this number, this just puts it all into perspective: 1,339%. That's the expansion in their trailing 12-month earnings per share. It's a number so big it almost doesn't feel real, but that right there is the engine that has shot this stock into the stratosphere. So, how does this stack up against everyone else? Well, to put it in perspective, take a look at this. The blue line, that's Lilly. The red line, that's the entire S&P 500 healthcare sector. You see, Lilly isn't just growing faster, it's playing a completely different game. The numbers don't lie. Lilly's earnings are up 368% in 2 years, while the rest of the sector just managed 45%. It's just total domination. But you know how it goes. With that kind of incredible growth comes an incredible price tag. And this is where we have to put on our professional cautious hat. So let's flip the coin and look at the bear case. Let's break down the specific red flags that have analysts hitting the brakes and saying, hold, not buy. So here are the big worries, the things that should really make us pause. First up, you've got that consensus hold rating from analysts. They're clearly nervous. Second, that explosive growth, it's starting to slow down just a bit from its absolute peak. Then there's some uncertainty in the pipeline. A key drug trial didn't quite hit the mark. And finally, you just can't ignore the valuation. A forward PE of 52, wow. That, plus the ever-present risk of governments trying to push down drug prices, it's a lot to consider. Now, this chart is really interesting. Check this out. The stock price tripled, but the PE ratio, the thing that tells you how expensive it is, actually dropped by 85%. How is that even possible? Simple. The earnings grew even faster than the stock did. It's what we call valuation normalization. But here's the kicker. Even after that massive drop, it's still trading at a huge premium. And here's the bottom line on just how premium we're talking. The stock is trading at an 86% premium compared to its peers in the healthcare sector. Let that sink in for a second. You are paying way, way more for this company's growth than for anyone else's. And what that means is, if there's even a tiny stumble, the fall could be pretty big. So the story seems pretty cut and dry, right? Great company, but just way too expensive. But hold on. This is where the story takes a twist. There's a really important piece of evidence, a contrarian signal, that comes from the one place you can't ignore, inside the company itself. So you have to ask yourself, with all these risks, with this crazy valuation, what could possibly convince someone to buy? What kind of signal would be so powerful that it makes you say, you know what, I see what the analysts are saying, but I'm going in anyway? Well, the answer is this: insider conviction. Look at this table. We're talking about the CEO, the chief scientific officer, board members, the people who know this company inside and out. And what are they doing? They're buying millions of dollars of their own company's stock with their own money. This isn't just for show. This is them putting their money where their mouth is, and it's a huge vote of confidence. And here's the absolute most important part of this whole thing: the timing. When did they buy? Not when the stock was soaring and everyone was happy. No, they bought after the stock got hammered because of some disappointing trial news. Think about that. When the top brass buys into bad news, that's one of the most powerful signals you can ever get. They're basically screaming at the market, "You've got this wrong." Okay, so how do we reconcile all of this? We've got the insane growth, the terrifying valuation, and this massive signal from the insiders. This is where we bring it all together into a clear, actionable playbook for how to actually approach this stock as an investment. Look, a pro doesn't just jump in with both feet on a stock this volatile. That's a recipe for disaster. The smart play is a two-tiered entry strategy. You take the first chunk of your capital, say 60%, and you get in on a decent pullback. Then you keep the other 40% in your back pocket, ready to deploy if we get a really big drop. That's your opportunistic move. So for that first tier, your conservative entry, you're looking for the $850 to $950 range. The idea is to let the stock cool its jets a bit, let some of that crazy momentum die down, and get in at a price that feels a lot more reasonable than the absolute peak. Now, for that second tier, your opportunistic shot, you're targeting the $650 to $750 range. And this zone is absolutely critical. Why that range specifically? Because that is the exact price level where the insiders showed up with their own cash and bought heavily. We call that the insider conviction zone, and it's a powerful level to watch. So that brings us right back to where we started. You've seen the paradox, you've seen the data, and now you have a playbook. But the fundamental question is still there. Is Eli Lilly's incredible story actually worth the incredibly high price of admission? And that, well, that's a decision every single investor has to make for themselves.